What if I tell you that there is a way to make money out of somebody's worries? Even better, what if you can build a $1 million industry just by taking advantage of others' risks and uncertainties? Like starting an empire out of a promise. Sketchy? Scammy? Well, not really. In fact, chances are you've already purchased this kind of promise from other people in the hopes that the day you've been worrying about never actually comes. If you were thinking about insurance, you are correct. I'm pretty sure that we all know what insurance is, or at least we get the gist of it. In simple terms, insurance is the taking away of your worries in exchange for a negligible amount of money. In other words, risk reduction. These risks will then be spread through a community to even minimize them. But take note, insurance doesn't have the power to prevent your worries from actually happening. Instead, when that worry arrives, they have the power to minimize your burden by providing you with the financial capability to get through it. Are you worried about getting sick in the future? Get health insurance. Are you worried about having a car accident? Get car insurance. Worried about the loved ones that you'll leave behind once you pass away? Get life insurance. Almost all of our modern day financial worries can be solved by getting insurance. However, one might wonder, is this business industry a product of modern problems? In its current form? Yes, but we can trace its roots all the way back to 1700 BC. Even before people discovered the concept of light bulbs, people already had good ideas on how to make money by selling risk reduction policies. More likely than not, you are aware of various kinds of insurance policies that exist today. I think we can all agree that at some point we have seen advertisements on TV or on social media about the advantage of getting them. But even before these policies and companies ever existed, historically, people already have been worried about these risks. People have been worried about losing the ones they give value to. Throughout the course of history, people have been sharing a common foe, the worry of losing something or someone that they care about. And from the need to secure valuables and manage risks comes one of the earliest known insurance transactions, bottomry bonds. The word bottomry refers to the bottom of a ship, hence the name. The bottomry bond is a maritime transaction and is not exactly a kind of insurance, it's more of a loan. During 1800 BC, bottomry bonds were used by early Babylonian and Chinese merchants. To simplify how bottomry bonds work in these ancient times, pay more attention. Let's say you bought a bottomry bond from a vendor and made your ship the collateral. You will have to pay the original amount you asked for, plus the interest that you and the vendor agreed upon if the ship completed its voyage successfully, safely, and intact. This is where the profit of the vendor comes from. However, if your ship gets stolen, destroyed, or sank, then you are cleared of the money you have borrowed. Bottomry bond is a very clear illustration of how two parties can capitalize and see a profitable opportunity from risk. If the ship arrives safely, profit for the borrower. If the ship gets wrecked, profit for the lenders. Let's jump forward in time a little bit, and let's visit the Kingdom of Mesopotamia from the years 1792 to 1650 BC. If you are familiar with your history, I'm pretty sure that you know who King Hammurabi is and his set of laws called the Code of Hammurabi. Here, we can also see an early type of insurance implemented in his kingdom back then. In his codes, or set of laws, he has conditions that provide benefits to merchants, landowners, and bankers in his kingdom who lost their profits or belongings to thieves or burglaries. It states that if the state or the authorities in the kingdom can't find or catch the thief, you have to audit what you lost and the kingdom will pay you for those losses. And because of this unique and interesting law in ancient times, it has been known as the first kind of insurance claim that existed in history. Even though there is no profit-making element present in the situation, it is still considered one of the earliest known forms of insurance because there is still a risk reduction involved due to the unwanted loss of valuables. Fast forward to the Middle Ages. Around 500 to 1500 CE, guilds were very popular. And surprisingly enough, guilds have their own contribution to insurance history. Every member of the guild should pay a membership fee in order to keep the funds rolling. Here, guilds have big coffers or wooden boxes that act as insurance funds. The funds then will be used in certain conditions, like if a member's place burned down, if a member was robbed, or if a member was disabled or worse, killed. This type of system is known today as general social insurance, or is often called Social Security. Basically, this is a form of insurance because the risk is reduced by spreading it among a group. The group then has equal opportunities to get the funds and benefits through contribution and affinity. Speaking of groups, the next step in insurance history is considered its cornerstone. Here, a group of people took to saying, "Let's talk over coffee," to a whole new level. And little did they know, their love for caffeine and business brought one of the most successful businesses in today's society. Let's look at Lloyd's. In the late 1600s, a coffee shop in London owned by Edward Lloyd's became one of the famous spots where businessmen, merchants, sailors, and other wealthy people came together to discuss businesses. One of the most popular topics at the time in that place was insurance, bottom-line bonds to be exact. For every agreement made here in Lloyd's coffee shop, a contract signing happened. Ship owners who then avail of bottom-line bonds from merchants should sign underneath the name of the risk, hence giving birth to an insurance terminology called underwriters. After several years and countless transactions made in Lloyd's coffee shop in London, the owner then decided to create their own publication called Lloyd's Listings. This list contains documents, requirements, and other important and relevant information about the individuals who underwrite certain risks. From then on, the company grew in size, profit, and in prominence. Today, we know it as the insurance company, Lloyd's of London. Despite being around for hundreds of years, how do insurance companies, or the insurance industry in general, keep on being one of the biggest and most sustainable businesses in the world until today? Let us simplify the explanation and eliminate technical terminologies to illustrate how insurance companies make their money. Let's have two persons having a transaction under an agreed condition. Let's name them David and John respectively. David says to John, "Here is $1,000. If I got sick, you have to pay my medical bills." If John agrees, this is called insurance. Insurance, in its most simplest definition, is a financial agreement in which a company is taking away risks from an individual in exchange for a premium and spreading it around a community. Insurance companies make money because they accept premiums from individuals with favorable risks based on their calculation. So now, John thinks that David won't get sick and he is $1,000 richer. He then calculated and accepted the risk. An insurance agreement was made. Now, if John could find, let's say, 10 more people who are willing to accept the same agreements as the one he had with David, he will then be $10,000 richer. Imagine if only one of those 10 got sick. John still has a lot of money to work around. This kind of system can continue on and on. It's like a pyramid scheme, but with no shady transactions and get-rich-quick promises. But that's not all. John can actually sell his policy at a lower price so he can get a riskless profit from it. For example, he can sell his $1,000 policy for $900. He can make a $100 profit for each resold policy, and for every 10 of these, he can make a clean $1,000. In the real world, Lloyd's of London follows this exact system. Insurance that goes through the building will be reinsured into smaller companies across the globe, hence giving justice to the definition of insurance, spreading of risk to a community. Not only that, but insurance companies can also make money by making even more policies. Let's take John again for example. John can make agreements with other people about their properties, belongings, and valuables. This is how a simple risk, a simple worry, or a simple need for security can provide the opportunity for exponential financial profit. This is also how Berkshire Hathaway in the US, Ping Insurance in China, Allianz in Germany, and AXA in France became some of the largest insurance companies in the world. Respectively, the estimated market capitalization of these insurance companies is $714 billion, $141 billion, $89 billion, and $65 billion. No wonder a lot of startup insurance companies are showing up these days. They won't run out of customers because people will always have things to worry about, albeit health, properties, vehicles, education, and even pets. And this multi-billion-dollar industry was all made possible because of our worries and the thought of the comfort of not having to worry about something financially. I mean, who would want to go bankrupt in an instant? Who would want to waste all of their life savings just because of one quick unwanted event? After all, prevention is better than cure. How about you? What do you think about insurance these days? Let us know in the comment section below so we can have a healthy and fruitful discussion about the best way to keep our worries away.